Hello everyone. In our previous two classes, we have seen preface of economic survey and chapter 1 of economic survey, which is state of the economy. So these two preface and chapter 1 are like summary or overview of the entire economic survey. So we have touched on multiple topics. From now on we are moving to chapter 2, starting with chapter 2. Now starting from chapter 2, each chapter discuss about a particular theme. Like chapter 2 is about fiscal developments. Chapter 3 is about monetary developments. Then there will be a chapter on agriculture, there will be a chapter on industry, there will be a chapter on services, there will be a chapter on urbanization. Okay, so there will be a chapter on environment, there will be a chapter on artificial intelligence, etc. So from now on, we are going in depth into the economic survey. Okay, so let us start. So the title of the chapter 2 is this: Fiscal Developments Anchoring Stability Through Credible Consolidation. This is the chapter 2. If I have to summarize entire chapter 2 into one core idea, this would be it. The chapter argues that India has achieved credible fiscal consolidation without sacrificing capital expenditure, which differentiate it from many global peers. So what does it mean? It means that there is a need for something called fiscal consolidation, and India is trying to achieve it. India has achieved it in some way, and it has achieved it in a good way, credible way. Why it is credible? Because it has done without sacrificing some other things needed, like capital expenditure. And it differentiates India from other global peers. So what does that mean? That means other countries are not able to achieve it, but India was able to achieve it. Okay, so let us see what is it. So first, understand some basics. So we all know every country needs some financial economic stability. So in previous classes also we are seeing that the more stable a country is financially, economically, more investors will be interested in investing in the country. Like foreign investors, if they have money, they want to invest in India. So now they are looking at the stability of the country. So what do I mean economic stability of the country? There are various economic factors like prices of goods and services within the country should be reasonable. Okay, then it should have enough foreign exchange reserves. Yesterday we have seen, in the previous class we have seen that every country ideally should have enough foreign currency reserves to at least buy its imports, to fill its import bill. Okay, so there is a need for minimum foreign reserves, okay, to have enough external balance. Then there is a need for fiscal sustainability. That means your debt level should be manageable. Like take for a human example, like let's say I am a human and I have borrowed some money. So when I borrow money, that money I have borrowed should be in reasonable limits. It should not be too much beyond my capacity. So when a country borrows, like all that investment, foreign investors or domestic investors, Government of India also needs it. Government of India also have many expenditure. Government of India has to do so many things. So it needs that money. It has to borrow, but that borrowing should not be too much. So debt level should be manageable. Okay. Every component we will see in depth inside. Okay. Then resilience of the financial system. Financial system should be resilient. That means the banking systems, etc. should be stable. We have seen already this is happening. Yesterday in previous class we have seen that banking industry in India is comparatively stable. Then we have seen that inflation is also comparatively stable. Okay, and we have also seen that we have enough forex reserves in the country. So now let us talk about debt levels. Okay, in fact India is also managing this. We will see more details on this. So stability is needed for any country to attract foreign investment and to have good economic system. And what does stability mean? Stability means absence of extreme volatility. Okay, like prices should not go too high, too low very frequently. This is volatility. So in the economic parameters, there should be less volatility, more stability. So how does it work? First we establish stability. Any economic system or any country, first they should establish stability. They should reduce risk for the investors. They should take decisions to enable more businesses, okay, more investments, okay, ease of doing business, okay. Then they will have sustained high growth. So more investment will come, The more the investment, the more growth will be. More people investing in new factories, new companies, more employment, more taxes, more revenue to the government, more products will be produced, more growth to the country. Okay. So, how to achieve this economic stability? Government has something called fiscal policy. Fiscal policy, okay. How to achieve this economic stability using something called fiscal policy. What is fiscal policy? So, every government, whether state or union government, they will have certain revenues, like Government of India collect taxes, income tax, corporate tax, okay, and GST, etc. They will have certain incomes. They will have certain expenditures, like government has to pay salaries to the government employees, army personnel, etc. So, managing the policies related to revenue and expenditure in such a way that your economy operates at most efficient level is the fiscal policy. Okay, what is policy? Policy is related to revenue and expenditure so that your economy operates sustainably is the fiscal policy. So, whatever government does that is related to revenue or expenditure is fiscal policy. Okay. So, the operation of fiscal policy in such a way that deficit should be reasonable. That means if you are earning more, your revenue is more than your expenditure, the amount you are earning more than the amount you are spending, then you will not have deficit, you will have surplus. But if you are earning less but you are spending more, then you will have deficit amount. Okay, you need to borrow from outside because your revenues are not enough, then you need to borrow. Okay, so here comes the concept of deficit. Okay, deficit in finances. So, when you are managing your fiscal policy, the deficit you come at is the fiscal deficit. Okay, fiscal deficit. So, I will tell you why I am telling you all this basic. Okay, within a few minutes it will make sense. So, you see here, so countries need to be very disciplined. They need to spend only wherever required. Otherwise, they will go into deficit. They need to borrow higher amount, and we already know high borrowing is not good. Okay, so they need to earn more. They need to spend less. They need to borrow very less amount, reasonable amount. Okay, so fiscal deficit should be reasonable. Then you are disciplined, and you will gain investors' confidence and higher investment. You will be given good ratings by the sovereign agencies. Okay, you will have stable path. Okay, with a reasonable borrowing cost. But if you are not disciplined, investors will lose confidence in you, in your country. Okay, you will have many negative effects. Okay. So, how do we operate our fiscal policy? So, the operation of fiscal policy is usually done through every year's budget. So, budget means when the financial year is coming, like this new financial year 26-27 is starting from 1st April 2026. So, on 1st February 2026, just 2 months ahead, government is announcing its fiscal policy for the upcoming financial year. So, the documents related to this announcement we call budget. Okay. So, in the budget, which is the annual financial statement we have seen in the previous class. Okay. So, there will be multiple things, like first of all we have some internal priorities. Not everything is related to economics. We have some priorities, like we need to help people. We need to give rations to poor people. Okay, we need to help like various vulnerable sections. We need to give some schemes for women. We need to help students. Okay, we need to procure enough medicines for the people in the country. So there are various priorities for the government, for which funding also will come from budget. Okay, so after priorities, you need to set some targets, because you need to be disciplined. Any disciplined person or a country needs to set some targets. You need to give a clear signal to the people that I am trying to be disciplined. I am also taking care of my requirements. Then I will also follow the economic discipline, and this will be my future policy. You are announcing to the future investors. Okay. So this is how fiscal policy operates. So now enough with the theory. Now what is the present situation across the world? So every country needs economic stability. So I am just giving you the basics so that you can understand this chapter 2 of economic survey better. Okay. So what is the present situation across the country? Okay. First of all, most countries are seeing very slow growth. Many countries are seeing very slow growth. After COVID-19 pandemic, the inflation rate, the prices in every country has gone too high. Okay, now they are cooling down. So inflation and rates are like going in different directions in different countries. Some countries are having very high inflation, some countries are having decent inflation, some countries are having low inflation. Okay, so we have seen in previous class also, China is experiencing deflation. That means there is prices are falling in that country. Okay, so different countries are going in different paths. Then we have debt distress. Debt distress means many countries have too much loans. They have borrowed too much. So many countries like US and Japan very high debt levels. Okay, India also comparatively had high debt levels. So this is the present situation. At the same time, we are facing new risks. So we are seeing these trade wars, okay, export restrictions, many wars going on in the world, okay, Russia-Ukraine war, etc. So much geopolitics, we are polluting the environment, so we need to move from fossil fuels to non-fossil fuels, etc. So there is a need for energy transition. So much of climate change happening, many climate calamities are happening, okay. So this is the present scenario about the world. Okay, so now let us focus this debt component, because right now of all the parameters needed for economic stability, India is having good in all of that. The two things currently troubling India are, one is high debt, second one is depreciation of currency. Okay, so in the previous class we have already seen, okay, in the preface itself, economic survey has clearly established that if you want to have strong currency, the answer lies in the manufacturing sector and exports. Develop your manufacturing sector, promote your exports, export more products to the world, then you will gain enough currency. So you will have your current account deficit reduced. That is the only solution for strong currency and even cost of the capital. That means interest rates in the country. This we have seen in the previous class. So what is the other problem India is facing? High debt levels. Okay, high debt levels is the one of the other problem. So let us see that. Okay. So it started from 2008 crisis. In 2008, whole world has seen a severe financial crisis. Starting from that, we are seeing so much of like increase in amounts borrowed by, loans borrowed by many countries. Okay, the debt level of the world is continuously increasing. So after 2008, within few years, we have seen again COVID-19 pandemic. So the debt levels of the world across the borrowings of the various countries across the world is increasing continuously. So if you see, various international organizations like IMF, they have suggested a safe level to many countries. So what is the safe level of borrowing? Sir, if you are a developed country like US, like Japan, if you are a developed country, you can have debt levels, that means the amount you borrow, up to 60% of your GDP. If you are a developing country like India, you can have debt levels up to 40% of your GDP. So up to 40 levels you can borrow, it is fine. It is fine. But what is the present situation? This is average debt level of advanced countries, developed countries. They are supposed to have 60%, but the average is coming around 113. Now what about developing countries like India? They are supposed to have 40%, but the average is 74%. Okay, so all the countries are having very high debt levels. So what about specific countries, debt levels of specific countries? So if you see USA, an advanced developed country, it is having 125% against 60% ideal level. So 125% of its GDP. So its debt level is more than its GDP. Okay. Then see Japan is having 230%. Okay. So Japan, even if having this much of debt level, why it is stable? Because most of its debt is internal. It is borrowing from its own citizens, not from outsiders. That is the difference between Japan and other countries. That is why even after having this high level of debt, Still Japan is comparatively stable. Okay. Now what about China? China is not a democracy. China does not report properly. So whatever China says, people cannot go and verify. If India says my debt level is 55, all the economic organizations will come to India will check whether it is 55.1 or 55. So other countries are very transparent, but China is not. So China says like my debt is only 80 to 90%. But many organizations believe if you take all the debts of all the government levels, including the local government levels of China, it is more than 120-130%. Okay, so you can say China is between 80 to 120-130. Now what about India? So India is comparatively, if you compare with other countries, India is having like 81% debt level. What is 81%? I mean debt of Union Government of India, all the state governments in India, all the local governments in India. So total combined general government debt. Okay, so in previous class we have seen general government debt means debt of all government levels. Okay, so is roughly 81%. So for India also it is more than the 40% prescribed limit. Developing countries prescribed limit is 40%. So we have too much debt, almost double than what is the ideal level. Okay, so this debt is one of the worrying thing for us. Okay, so we have seen the debt levels of various countries. So now there cannot be any doubt, we need to reduce our debt level. We need to gradually reduce our debt level. Okay, that is agreed. So how do we do that? Government has came up with a plan called glide path. Okay, so glide path strategy. What is glide path strategy? Simply glide. Okay, just gliding. So I have too high debt now. Okay, the debt amount compared to my GDP is too high. So I will glide slowly, not suddenly I will fall. I will not just jump or drastically reduce. I will just repay all my loans and take it to suddenly 40%. No, it cannot be done. It will come at great compromise. So what I will do? I will take a glide path. Slowly I will decrease my debt so that in future it comes to manageable, reasonable levels. Okay, so that is the glide strategy. So if you see fiscal deficit, that means the difference between expenditure, total expenditure and total revenue of the government. How much I am receiving, how much I am spending. The difference is fiscal deficit for the government. So if you see the fiscal deficit of government of India after COVID, so in 2020 we have seen COVID. So immediately after COVID our fiscal deficit went to 9.2%. So this financial year from April 2020 to March 2021. So this financial year our fiscal deficit has gone very high to 9.2%. So it is generally agreed that fiscal deficit is acceptable up to 3%. 3% fiscal deficit is recommended, acceptable. But we have 9.2, very high. Okay. That means if fiscal deficit is high, our borrowings will also go high. That is the problem. Fiscal deficit means shortage of money. So we need to borrow. We are already having too much of debt. So high fiscal deficit is dangerous. So we have taken a glide path. So from 9.2 we started decreasing. We will see in next slides, we will see detailed picture. So this year it came somewhat 4.4. So somewhat it is okay. We have gone to reasonable levels. Okay. So debt is decreasing slowly. Our fiscal deficit is decreasing slowly. Okay. Then we will see all of this primary deficit, etc. So now what about? So now we know government needs to be disciplined. This discipline of managing debt and your fiscal deficit is called fiscal consolidation. Okay. So when I fiscal consolidation. Okay. When government is taking proper actions to reduce fiscal deficit, to reduce debt of the country, it is called fiscal consolidation. Okay. So how to achieve this fiscal consolidation? We are seeing that India has reduced its fiscal deficit how India is doing that, okay? How India is able to achieve that, you have to understand. To understand that, we need to know the budgeting process, the operation of our fiscal policy, how it is operated. See, this is the budget. We have broadly two components. This is the components of the budget. We have various types of revenues. We have various types of expenditure. Okay, various types of revenues. Revenues means receipts. Various types of expenditure. Okay. See, till now I am speaking. Revenue means receipt. Whatever I am getting, I am receiving. Okay, receipt or revenue. But here when I say revenue in the components of budget, I mean regular. Okay, frequent. Okay, here I am replacing the ordinary revenue term with receipts. Okay, these are receipts, something which I receive. This is receipt, something which I receive. This is expenditure, something I am spending. This is expenditure, something I am spending. Okay, so let us see the components of budget. Okay, here I mean by revenue means regular, frequent. Okay, something that happens almost every month, regularly, at regular intervals. So revenue budget means if I take out things that happen very frequently, like payment of salary happens every month, payment of tax happen every year. Okay, there are some things happen at regular interval. So when I budget those receipts and those expenditure, I call it revenue budget. There are some things that does not happen at regular intervals, happen at like very rarely. Like if I sell my company, let's say there is a public sector enterprise and government has sold it and government has got some 2 lakh crore on it. Now it will be a capital receipt. Okay, government has borrowed a loan. Then it is one of thing. It's not like government borrows every month. Okay, so irregular things, rare things come under capital budget. Okay, so capital budget is something because it is involving huge amount. It is not regular. It affects your assets and liabilities. Assets means something you are entitled to. You want something. Liabilities mean something you have to pay back. It puts a burden on you. Okay, it puts a future burden on you. So something that affects your assets and liabilities is the capital budget. Those transactions which does not affect your assets or liabilities and happen at regular intervals are part of revenue budget. Okay, so budget, the whole budgeting process of managing receipts and expenditure, I am classifying into two. One is revenue budget. This is static part, but I have to tell you this so that you have to understand, you have to appreciate the content in the next slides. Okay, so taking revenue receipts, that means things which government receive regularly without affecting its assets or liabilities. One is tax revenue. So government regularly receives tax. There are other kind of revenues like non-tax revenues, like every year RBI pays something called dividend to the government of India. So if you see this year also RBI has very recent current affair. RBI has paid some 2,63,000 crore, okay, to the government of India because it is having the excess profit. So under tax revenues, we have direct taxes and indirect taxes. What are direct taxes? So the income tax people pay on their income, salaries, etc. Income tax. Corporates, companies pay corporate tax. Then there are something called STT, security transaction tax on selling and buying of stock, shares, etc. Okay, securities. Then there are indirect taxes also like GST. Indirect means you are not paying it on your income or something, you are paying it on consumption. When you are consuming a thing, you will pay GST. You are going to a restaurant, you are consuming things, on that amount of consumption, value of consumption, you will pay some GST. Okay. Then there is excise tax. You can also add something like customs tax here. So there is another type of indirect tax, customs tax. Things which are produced in India and outside of GST are levied excise tax, like petroleum. Petroleum does not come under GST, petroleum will come under excise tax. Government will decide which is GST, which is excise tax. Things that are produced outside of India and are brought to India, custom tax will be levied upon them. So China, let's say China has produced a toy and it is exporting the toy to India. So when you are importing the toy, you will be levy customs tax on the toy. Okay, so it is about the tax revenues. Okay, now come to non-tax revenues. So non-tax receipts. So government can continuously sell some services or goods, okay, like regular things, like let's say on some land transactions or something. If for every land transaction, let's say you are supposed to pay this much to the government, stamp duties, etc. Some things are given to state, some things are given to the center. So when government provides services and you need to pay for that, then it comes under this component. Then dividends and profits from public sector enterprises, okay, investments of the government of India. So here you can take the example of RBI and many public sector enterprises, etc. Okay, so RBI every year gains profit and that excess profit will be given to the government of India as dividend. Then interest received from loans given. So government of India, if it is giving loans to any state government or any other party, so every month or every year it will receive the interest. So it will come under non-tax receipt, non-tax revenue. Grants received. So if any international organization like World Bank of India or Bill Gates Foundation, anyone is giving some, let's say some grants to developing countries, then India can receive it. So it comes under non-tax revenue again. Okay, so it is revenue receipts. Now come to the revenue expenditure, something government has to spend at regular intervals. Okay, salaries. So there are many employees working under the central government of India. Okay, so budget I am explaining with union government, central government, but same budget is also applicable for state government. Okay, this is for any government. So it will be paying salaries for people working under it. Okay, there will be interest to be paid on loans. Now we are saying every year India is taking many loans. So India has to regularly pay loans to it. Okay, interest charges to that loans. Then grants given. So government of India also gives many grants to many state governments. Okay, subsidies. So if you see, we are receiving many subsidies. Government of India gives many subsidies to its population. Like if you are a farmer, let's say fertilizer, a bag of fertilizer originally costs, let's say 5,000. You will not be paying full amount. Government will bear some 2,000 rupees or 3,000 rupees in it. You will pay only the remaining amount. So in India there is very high subsidies on fertilizer, food, okay, public distribution system, rations, etc. and fuel, etc. There are various kinds of subsidies. Then there is defense expense, okay, expenditure on defense, pensions. So all the retired people, when they are working, you will give salary. When they have retired, you will give pension. Now moving on to capital budget. So why I am telling you this? Here lies the strategy of how to fiscally consolidate. Without understanding this, you cannot understand how government is doing this fiscal consolidation, which is mentioned in the economic survey. Okay, so coming to the capital budget. So what are capital receipts? What are capital expenditure? So when we receive something, if it is putting us in a future liability, like taking a loan. If I take a loan of 1 lakh from a person, in future I have to pay back 1 lakh. This is a liability for me. So those things will come under capital receipts. Okay, example saying. So again, under capital receipts you will have two types, debt and non-debt. So debt creating capital receipts, non-debt creating capital receipts. Okay, so debt means simply taking loan. Okay, debt creating capital means taking loan. It can be from inside the country, internal debt, or outside of the country. Now what is non-debt creating capital? So there are some revenues which are not related to loans, not borrowing. Like I can sell a company. Government has a company. Few years back, Air India till 2 years back was owned by Government of India. Now Air India was sold to Tata's. It was privatized. So all the revenue generated from that particular transaction, now India has lost an asset. Okay, so there is a change in asset and liabilities. In this transaction, India used to have an asset. Government of India used to have an asset. Now Government of India has let go of that asset. So in return, it has got some money, which will be the non-debt creating capital receipt. This is also called disinvestment. Okay, selling your properties is disinvestment. Okay, or recovering your loans. So some 10 years back, I have given a loan to the state government. Till now, it has paid interest every month, every year, which is under the revenue receipt. But the final principal repayment comes under capital receipt. Okay. it is non-debt creating. Now coming to the last, capital expenditure. So capital expenditure. So if I give loan to something, now if I have given to loan to state government, that amount is coming under capital expenditure. Okay, loans given, capital assets. So like I have bought something, or I have laid a new road. Government of India has laid a new road. Now it costed something to it, a new national highway. It would have taken some 1,000 crores. So it is capital expenditure. Here you are creating a new asset. Road is a new asset. Okay. So investments in any company or any new, this road is also an investment, or renewable energy. Government will create a new solar park, which is an investment. So it will generate some power from it and it will sell that power to the ordinary customers. So this comes under capital expenditure. So this is how normal budgeting will be done. Now how to reduce your debt level, that means how to reduce your fiscal deficit. How reducing means, what does reducing fiscal deficit mean? Fiscal deficit means the difference between my expenditures and my revenue, my receipts. So when I say I have to reduce fiscal deficit, I mean I have to reduce my expenditure, I have to increase my revenues. That is a simple concept. So see this picture. So which should be increasing, which should be decreasing. So to have higher revenue, you need to increase tax revenues. You need to increase, in fact, revenue receipts you need to increase. Any kind of revenue is acceptable, welcome. Okay, the more I have, the lesser is my fiscal deficit. So it is desirable to increase revenue receipts. So when government needs to do fiscal consolidation, when government needs to reduce fiscal deficit, government needs to focus on increasing revenue receipts, which include increasing or rationalizing various kinds of taxes. Okay, generating new ways of non-tax revenues. Okay, then revenue expenditure. It is something that is spent by the government. So revenue expenditure needs to come down, but it should not mean you should not pay salaries, you should not pay money to the schemes, etc. So you cannot altogether make it zero, but you have to reduce it. So here comes the rationalization. Okay, it is called rationalization. Rationalization. That means I am reducing it without compromising on the essential aspects. Like let's take like subsidies. Now government gives rations to the poor people. Okay, PDS, public distribution system. Poor people will be given rations under PDS scheme. Can completely eliminate it? No, I cannot eliminate it. Poor people need that support. But I can eliminate duplicate ration cards, illegal beneficiaries. How do I do it? By linking PDS to Aadhaar enabled payment system, by giving direct benefit transfers, money directly into the accounts of the people. So I am taking fraudsters from the account. In that way, I can reduce my overall expenditure, at the same time maintaining essential things. If you see, that is why government is pushing technology very aggressively these days. Okay, everything is being linked to Aadhaar and PAN card, etc. Okay, so I have to increase my revenue receipts, I have to rationalize my revenue expenditure, then I have to reduce my debt creating capital receipts. Of course, the overall debt need to be reduced. So debt creating capital receipts, I have to bring it down to bring down fiscal deficit. Then non-debt creating, this is okay. It is non-debt creating. So what kind of things I have to do here? See, if I have given loans to anyone, I need to recover it. Then disinvestment. Good companies I don't want to sell. Government has many public sector enterprises. But if there is a public sector enterprise, but it is fully in losses, every year it is running in losses, maybe it is good to sell that. Maybe it is good to earn revenue from it. Okay, maybe it is good to disinvest it. Okay, so here also you can say you can increase the non-debt capital receipts, then capital expenditure. So this is very important. See, focus on capital expenditure. The difference between revenue expenditure and capital expenditure is that if I invest in revenue expenditure, I am not getting anything in back. Okay, it is end of the cycle. But capital expenditure is not like that. Okay, take that example of solar park. If today I have constructed a solar park, tomorrow it gives me power, many people will buy power, so every year it goes on like that. Again, capital expenditure. If I construct a road, so like I told you in previous class, let's say there are two towns which are completely disconnected, there is no economic activity happening between them. If a government lays down a road between those two, now they have connectivity, they can do economic activity into both the towns, so there will be an increase in transactions, economic activity. Government even can collect a toll on that road. So everyone who is using that road for raising some revenue or some other purpose, they need to pay some toll. So government also can earn whatever it is investing, at the same time it is boosting the economy. So here my point is, whatever you are investing in capital expenditure, you will earn it back in the future. It is very beneficial for the economy. All the construction of the roads, bridges, renewable energy projects, okay, nuclear energy projects, hydro projects, okay, and government giving loans to the state governments will build new capital things, okay, state governments will invest in productive things, state governments will develop more, okay, they will pay back, okay. So capital expenditure is a good thing. Capital expenditure is a good thing, it is desirable thing. So even though it is an expenditure, there will be returns in the future. So I will say, unlike revenue expenditure, capital expenditure also need to be increased, okay. So this needs to be increased, this needs to be preferably decreased, but not completely rationalized. This needs to be decreased, this needs to be increased, this needs to be increased. So this is what I mean, reduction of fiscal deficit. This is what I mean, fiscal consolidation. Now see what is government doing in this way. So this is the theory. Now let us see how government is doing this. Because government is reducing fiscal deficit from 9.2 in 2020, it has reduced to 4.4% in 4 or 5 years. Okay, the debt also coming down. Okay, the debt of the government of India is also coming down. So how government of India is doing this? Let us see. So first is, it is achieving revenue buoyancy. Okay, so revenue buoyancy means, that means it is increasing the revenue. That's what I mean. Revenue should be increasing. Yeah, revenue is increasing. Okay, so here you see it is talking about non-corporate tax buoyancy. So what is tax buoyancy? So tax buoyancy is this: for every 1% of increase in GDP, how much your tax is increasing? Let's say today India's GDP is 300 lakh crore. Just for example I am saying, okay, 300 lakh crore rupees. Just for example I am saying. And your tax collection is, let's say 30 lakh crore. Again example. GDP is 300 lakh crore. GDP is 300 lakh crore and your tax collection is 30 lakh crore. Next year we had good GDP growth and GDP has increased by 10%. That means 30. GDP has increased 30%. 10%, that means 30 lakh crore has increased. Next year GDP is 330. Okay, 330 lakh crore. Okay, so sorry, 10 for every 1% we are seeing tax buoyancy. So let's say now our tax also increased by 10%. So next year our tax revenues became 33 lakh crore. So GDP has seen 10%, proportionally our tax revenues also seen 10%. So for every 1% increase we are seeing 1%. Then you will call it buoyancy 1. But let's say for every 10% increase you are seeing 15% increase here. Okay, that means it has become 34.5. So let's say next year it has become 34.5 lakh crore. Okay, 3, 10%, 1.5, another 5%. So for every 10% increase we are seeing 15%. That means for every 1% we are seeing 1.5% increase in tax rate. So in this case tax buoyancy is 1.5. Okay, this is called tax buoyancy. Now let us see how they are achieving. So they are saying Sir, this non-corporate tax buoyancy. Non-corporate tax buoyancy. That means the particular non-corporate. This is corporate tax. Non-corporate tax other than under tax non-corporate tax buoyancies. Okay, these are non-corporate. Non-corporate tax buoyancy is 1.8%. Okay, so GDP increasing, it is increasing more fast, almost double as the GDP. Okay, now widening the base. Number of the people who are filing income tax returns has increased from 6.9 crores to 9.2 crore population. Okay, so total we have almost 145 crore population. Out of this 145 crore population, previously 6.9 crore people only used to file IT returns. Now you have 9.2 crore people have IT returns. Then there is something called nudge framework. Okay, it is called behavioral economics. What is nudge? Nudge means just gently pushing or poking a person. So nudging means previously, let's say I have not complied with this IT returns. Let's say I have not disclosed some income. I forgot to disclose some income. Previously, it is coercive enforcement. I am seen like a criminal for forgetting something that should be reported in the IT returns form. But now government is moving to more cooperative behavior, behavioral compliance. So previously they used to send me notice, appear before this income tax officer, you have reported wrongly, you have committed this fraud. So this action will be taken to you. The language, the action are very harsh. But now they are simply nudging people. They are giving a decent chance to the people. Nudging here means instead of taking severe action, they may just send an SMS. We have identified this small thing, just resolve this error. Or they may send a small decent letter. Okay, so giving a decent opportunity to the people to rectify their mistakes is the nudging. Okay, so this is how they are doing. Okay, this is how they are increasing the revenue. Here seeing the component of increasing the revenue. You can see here direct taxes are increasing. So previously, like some 2 to 3 years back, direct taxes and indirect taxes both are same. Value of contribution of both used to be same. Okay, so direct taxes, indirect taxes both used to be same. But now government is doing so many activities. It is helping people. It is taking a lenient action on people, and it is coming up with new policies every year budget. Now direct taxes are increasing. They have become 58% of the total tax revenue. Okay. So GST, last year we know the government has came up with some strong reforms in the GST. So for this year I would say GST becomes very important, because in 2016 GST was introduced. Now this year is 10 years of GST. Okay, GST becomes one of the very important things. So last year government has taken a strong reforms to the GST. Like previously we used to have 0%, 5%, 12%, 18%, okay, 28% slabs. But last year government is discouraging this 12%, 28% slabs. That means all the items in the 12% slab, government is moving into either 5%, most of them into 5% or 18%. Okay, so government is simplifying tax laws. GST is being simplified. Taxes on many items are being reduced. Okay, either they are being made 0 or 5. Okay, so these are GST reforms done last year. So because of that, we are having all-time high receiving of GST. So every month the amount we are receiving as indirect taxes is increasing. Okay, so tax structure is reformed, simplified. Okay, so they are expecting higher compliance with the lower tax. So if the tax amount is less, more people will buy. Okay, more compliance, higher volumes. So here you will see about something called rise in e-way bills. So you please also look at this e-way bills for your prelims. Okay, so e-way bills is electronic way bills, are something that you should generate if you are transporting goods from one state to another state. Within state is like if I am moving goods from Andhra Pradesh to Maharashtra, before my moving of goods, I have to go to the GST portal. I have to generate something called e-way. I have to pay some amount. I will report I am taking these goods of this amount, because as per law there should be some GST on it. So this is a e-way bill is like a assurance of yes, I am paying my GST. Okay, when you raise e-way bill, now government is like cools down. This guy is properly reporting what he is taking, how he is taking. So when I am taking my goods from Andhra Pradesh to Maharashtra, at any checkpoint they may check whether I have this e-way bill or not. So I am telling them I am not evading my tax, I am paying my tax properly. Okay, so e-way tax is a bill. So coming to the non-tax revenues. Okay, under tax we have seen direct taxes and indirect taxes. Now coming to the non-tax revenues. So I told you every year RBI is giving so much dividend to the government of India. So recently RBI has given 2.68 lakh crore to the government, very huge amount. Okay, just from RBI, the Central Bank of India, government of India has received 2.68 lakh crore. Okay, and all the central public sector enterprises, okay, all the public sector units are seeing so much of profit over the years. So that is how the revenue of the government of India is increasing. Okay, and monetization, like let's say government has many assets. Government has an airport. Now that airport can be given to a private party who is willing to pay more amount. Let's say government has an airport and government is earning some, let's say only 1000 crore from that airport every year. But now a private contractor came, now he is offering 4000 crore to you because he has a better business model. So when you hand over that airport to the private person, when you lease that airport to the private person for some 30 years or 50 years, now it is monetization. Any unused or old projects or assets of the government of India, it can be land, it can be a building, it can be anything. You can lease to the private parties and earn income from it. It is called monetization. Okay, so dividends we are receiving, efficiency is increasing, we are monetizing. Okay, we have national monetization pipeline also. So that is how we are earning non-tax revenue. So what about expenditure? So till now we have seen how government is increasing these revenues. Okay, revenue receipts, tax and non-tax, etc. Now what about expenditure? So it is rationalizing. I told you revenue expenditure should be rationalized. So it is rationalizing. Okay, like it is reforming subsidies. Subsidies, amount of subsidies, volume is decreasing, but without compromising to the genuine subsidiaries. Fraud accounts are being removed. Okay, and they have introduced something called DBT, direct benefit transfer. So instead of giving money to middlemen or companies, the amount of subsidy being given under various schemes, now they are being sent directly to the beneficiaries, to the genuine people. Okay, because bank accounts are now linked to Aadhaar and PAN. Now it is easy to verify who is a genuine beneficiary and who is not. Okay, so direct benefit transfer has curbed so much leakages, saved 3.48 lakh crore. See the amount of corruption happening before introduction of DBT, direct benefit transfer. When you introduce DBT and you are verifying genuine beneficiaries, you are removing the fake fraud beneficiaries, you are saving 3.48 lakh crore. Okay, you can mention this figure that economic survey has mentioned this introduction of DBT has saved 3.4 lakh crore in your mains answer. Okay. So at the same time we are also increasing our efficiency in our payments. Okay, government has came up with something called just in time funding system. Okay, just in time SNS purse. Okay, this is the portal of this payment SNS purse. So just in time SNS purse means if government has promised someone some payment, it will see this is how system used to work. Let's say Andhra Pradesh government has asked some loan to the government of India for some purpose, for constructing some wind power plant or something. So government of India promised some 500 crores to the government of Andhra Pradesh. So when they have made an agreement previously, government of India used to give that 500 crores. But government of Andhra Pradesh may take some time in using that money. The project may get delayed 1 year or 2 years or 3 years, or part of that amount will still be left. Meanwhile, just assume that now government of India needs another 500 crore. But government of India cannot use that 500 crore because it has already given to the Andhra Pradesh government. So government of India has to go for a loan. It has to borrow outside. But at the same time, this 500 crore is lying with the government of Andhra Pradesh unutilized. So this is inefficiency in distribution of the money. So now we have come up with this just in time. So in this case, now after this situation, only when Andhra Pradesh government is about to spend, just about to make the payments to the concerned party, only at that moment government of India will give. So it will promise, but it will not give money till the actual execution of the project. Okay, so this is how we are reducing our inefficiency. Okay, just in time SNS purse. Now, one new feature has been observed this year. For the first time, we have observed something called golden rule of the finance. What is this golden rule? So, every year we will have some fiscal deficit. So, we will borrow some amount. So, usually our borrowing is more than our investment, our capital expenditure. Okay, here investment means capital expenditure. So, government of India, we have seen this capital expenditure. So, this type of capital expenditure, now for this capital expenditure, usually government borrows and the amount borrowed is always higher than our capital expenditure till now in history. But capital expenditure gives return, but the remaining amount, the amount you are borrowing for other purposes other than capital expenditure, it is okay if I borrow and put it for capital expenditure because this will give me return. But my borrowing is more than capital expenditure. That means I am borrowing for something else other than capital expenditure. Maybe I am borrowing for revenue expenditure also, which does not give me any returns. But I have to pay interest on my borrowings. Okay, so this is a bad thing. Whatever happened till now, it is not good for finance. But now we have overcome it. Now we have achieved this golden rule. That means, so this word is mentioned in the survey. Okay, so what is the golden rule here? For the first time, our capital expenditure is more than net borrowing. That means we had some reserve amount for the capital expenditure. We have borrowed more, and all the amount we have borrowed, we have utilized it for capital expenditure. So we did not borrow money for revenue expenditure or other purposes. So this is a very good thing. Okay. So our net borrowing. Okay. So there are two concepts here: net borrowing and gross borrowing. So we will see in future slides. So compared to our net borrowing, we have our investment is more, our capital expenditure is more than our borrowing. Okay, so there is a very high capital expenditure push also. If you see as a percentage of GDP from 1.7% before COVID-19 pandemic, now we are investing 3% in capital expenditure as a percentage of GDP. Okay, then effective capital expenditure. What is effective capital expenditure? So 3% is central government capital expenditure, which is spent by the government of India directly in capital projects. Okay, in something that gives returns to them. But government of India is also gives some grants to the state governments. So government of India is also giving some grants to the state governments, but we are putting grants under revenue expenditure from my perspective. So for government of India, grants given to the state is a revenue expenditure. But what does that state do? So let's say state of Maharashtra has taken some 1000 crore as grant from government of India. It is a revenue expenditure, but for the government of Maharashtra, it is a non-debt creating capital receipt. Okay, it is a capital receipt because it is a grant, huge amount, rarely comes, and without creating any liability, creating an asset. So it is a capital receipt. Okay, so they will be using it for capital expenditure. They will be using for good purposes. With the 1000 crore, they will come up with a new project on which it will get returns. Okay, so at union level, it may not be creating capital, but at state level, it is creating a capital. So if I include Union Government of India's capital expenditure and also grants given by the Union Government to the states, it is the effective capital expenditure because it is the, for all practical purpose, both amounts creating capital. Okay. So here you can see, so Union Government of India directly spending 3% of GDP as capital expenditure, then it is giving 1.4% of GDP as grants to the state, which is capital expenditures for the state. They will be investing in projects which are giving returns. So total effective capital expenditure from the country's perspective standing at 4.4% of GDP. Okay. So borrowing is strictly for asset creation. It is not for wasting. It is not for giving regular payments. It is not for paying salaries. It is for getting something more in return. Okay. So next comes the state finances. So economic survey has expressed a concern about state finances. So we are seeing government of India is reducing its fiscal deficit through various measures. It is doing this fiscal consolidation. It is reducing its debt. But what is happening at state level? So economic survey says, sir, the path taken by many states are worrying. Many states in India are moving in reverse direction. Many states used to have fiscal surplus, now they are coming to fiscal deficit. Many states which are already having fiscal deficit, the amount of fiscal deficit is worsening. So they are not showing fiscal discipline, they are showing fiscal indiscipline. They are not doing fiscal consolidation, they are losing the control over their fiscal policy. So why is this happening? This is happening because they are resorting to many activities like unconditional cash transfers, populist measures. Okay, so just giving money to the people, just money giving to the women in the state of Bihar before recent elections, the then ruling government has given 10,000 rupees to every woman, okay, to eligible women. Similar thing happened with state of Tamil Nadu recently. They have given some amount, some 5,000 to some section of population. So in many states we are seeing this populist measure just before elections, just to win over the elections. But this is not good for economy because what do we need? We need to reduce our revenue expenditure. We need to increase our capital expenditure. If you are spending, spend in a more productive way, which will give you more returns in the future. Okay. So unconditional cash transfers are bad. Okay. And then even though states are doing this, okay, and states are also doing another thing called off budget borrowing. So what is off budget borrowing? So take a state government, let's say state of West Bengal. It will produce a budget. It will give a statement saying that these will be my revenues, these will be my expenditure. So this is my fiscal deficit. My fiscal deficit is, let's say, 4% of my GDP, GSDP, gross state domestic product. So I am taking this 1 lakh crore loans. But after 3-4 months, without announcing in budget, there may be some state public sector enterprises, some organization working under the state government. That organization will take a loan and spend for public purposes. So a public sector enterprises on behalf of either state government or central government will take a loan. Why state government is not taking that loan directly? Because then on paper it will increase its fiscal deficit. It will show poor performance of its fiscal policy. So many governments are resorting to this tactic of taking borrowing, taking loans, but they are not taking on their name. They are not announcing in their budget. They are using some other companies, other public sector enterprises as disguise and taking loans which they want for public purpose. So these are called off-budget borrowings. Okay. So state governments are resorting to things like this. That is why they are feeling the stress. Okay. So desired level is 3%, 3.3%. But if you take the average, they are having almost 3.2% of. On an average, every state is having 3.2%. Some states are having above average, some states are having below average. Generally accepted is 3% of GDP, but here we are having 3.2%. Okay, so states are, just now we are seeing a fiscal stress, okay, increase in fiscal deficits of various states. Okay, there are some negative consequences. So when state governments is doing this, it is coming at a compromise of capital expenditure. As I told you, we need to spend more on capital expenditure, okay, capex, capital expenditure, but you are giving money just like that. You are giving unconditional money transfers to the people, so you will not be having any money to spend on capital expenditure. Then you will go out and borrow, which will again increase your fiscal deficit. Okay, so it comes at a cost of capital expenditure. The amount which is supposed to be spent on capital expenditure is spent on other kinds of expenditure. Okay, but in these times, central government is helping state governments through some transfers. Okay, this we will see in later slides more depth. Okay, there is a scheme. Under that scheme, central government is giving many transfers to the state governments. So central government is giving loans to the states. Central government is giving grants to the states. Okay. Now, so this is a scheme of the central government for states. So we have a scheme called Special Assistance to States for Capital Investment. Okay, Special Assistance to States for Capital Investment, SCSCI. So under this scheme, states will be given 50-year interest-free loans. That means for 50 years, they do not have to pay loans for the government of India. Okay, union government. They have to use it for capital projects. Okay, not for revenue expenditure, exclusively for capital expenditure. Okay, till now 1.5 lakh crore is allocated for the last financial year from April 2025 to March 2026. Okay, so this will ensure minimum capital expenditure in the states. Okay, so this is the scheme. So you see the global scenario. The debt levels of all the other countries in the world is generally increasing. But because India is doing this fiscal consolidation, India is showing I am following discipline to all the global investors. So India's debt rate is actually falling. Okay, is actually falling. So previously we used to have like 63-64% of our union government. I'm talking about only union government. Total union, state, all, everything combined, it's around like 81%. If I exclude states and local governments and I talk about only union government debt we used to have around like 63-64% of GDP. From that we have reduced to 7.1% in the last 4 or 5 years. So right now it is around some 56. Okay, around 56 is our current debt level of Union Government of India. Okay, and we have a target. Union Government of India has a target to reduce this 56% of debt level to 50% of GDP. Okay, by 2030. So in the past 5 years, we have reduced 7.1%. In the next 5 years, we want to reduce another 6%. Okay, so this is the target. So our target is 50% of debt level for only union government I'm talking about. Okay, by 2030. So correcting distortions. Okay, so government is also taking another action. So there are many distortions in India, like we are putting very high freight rates. Movement of goods is freights. So in railways predominantly two activities happen. One is carrying of passengers, another one is carrying of freight rates. Okay, carrying of goods. Okay, carrying of goods versus carrying of passengers. So there is a need for increase in rates of passengers also. So let's say to carry a passenger from city A to city B, let's say for government, including all cost, it costs let's say some 20 rupees. But governments are afraid to take money from common people, because common people, they may show it in the voting. Okay, so if it is costing 20 rupees for government genuinely, government will not take 20 rupees, government will put the ticket price of the train at 10 rupees only. Okay, now what we'll do? Now let's say there is a goods train which is carrying goods and it is taking again from place A to place B. Again the expense is let's say 20 rupees per kg. But on this goods train, government will increase the price and it will collect some 40 rupees to compensate for the concession in the price for the passengers. So for passengers it is not increasing, but for the goods it is increasing severely. What is the negative consequence of it? The negative consequence of it is that it is affecting business. Okay, again it will give low confidence to the investors. So such kind of distortions we are reducing. Okay, so you can see government is also passing a new act to reduce such distortions and high electricity prices in the power sector also. Same goes for the power sector. Government generate power, it gives to the industries, commercial operations, and it gives to households, normal people. So government collects very less amount from the normal people, ordinary people, from households, but it charges too much amount from the industries, commercial businesses. So it makes business very unviable. So such kind of reforms government is taking. Okay, so here the theme is separate welfare objectives from economic pricing. Your economic system shall operate optimally. Okay, optimally. So don't mix welfare and your economic operations. If it is costing this much, collect that much amount from the passengers. Okay, you give some other welfare measure in some other sphere. Okay, so these kind of distortions also we are correcting. So macro outlook, credibility as capital. So overall what we are doing? So we are showing credibility, we are showing discipline, and that will be our capital. Okay, so all the positive actions India is doing is recognized by the world. Many sovereign rating agencies, in the previous class also we have seen some agencies like S&P are increasing the ratings of the India. So they are telling the investors across the world, now you can depend on India, you can trust India, you can invest in India. Okay, and our GDP growth is good. Okay, our nominal is 7% for the next upcoming financial year. We are projecting for the upcoming financial year from April 2026 to March 2027, we are estimating 7% real GDP growth, which is very good, and nominal GDP growth we are even expecting 10%. Okay, so we are having high hopes for the future. Then we already know inflation is moderated in India. Okay, so we are doing so many good actions and we are getting the rewards. Okay, wherever the concern exists, we are sorting them. One of the concern highlighted is the fiscal discipline of the state governments. Okay, so we are focusing on 5 pillars. You can see here it is mostly factual. You can see we have already seen. So we are increasing the revenue. We are not reducing any expenditure unfairly. We are not cutting benefits of anyone. We are assuring all the minimum expenditure. We are focusing on growth by increasing the revenues. Then we are not compromising on capital expenditure also. We are following the golden rule of more capital expenditure than borrowings. Then we are using behavioral economics like nudge and just in time, etc. Okay, instead of harsh. Okay, we are using technology for increasing the efficiency. Then we are supporting, union government is supporting states in managing the fiscal consolidation, fiscal policy, and we have a target of 50% debt to GDP ratio by 2030. Okay, so this is, now let us link this to the budget. We have seen economic survey. Just take a 2 to 3 minutes of break. So after this 2 to 3 minutes of break, now let us see remaining portion of budget and also 16th Finance Commission recommendations related to this. We are talking about fiscal policy. So all the topic, all the components in the budget, okay, all the highlights of the budget this year related to fiscal policy, we will see here. At the same time, after budget, we will also see all the recommendations made related to the fiscal policy in the 16th Finance Commission is also, we will see here. Okay, so just 2 minutes. So discussing the fiscal policy aspects of the budget. Okay, so this is mostly factual only. So all the factual things I will move on. You just pause the slide and read. Okay, or anyway you will read budget for the prelims. So factual details you can see. Wherever there is a need for explanation, I will explain. So you see here, government has introduced a new income tax act. Okay, this is one point that is worthy of discussion. So anyway, these figures you don't need to know for the exam also. Let's see here, income tax slabs you don't need to know. Okay, income tax slabs you don't need to know. For the exam, how much is the TCS, TDS, you don't need to go into all of that. Okay, just understand the broad concept. You should know what is TCS, what is TDS. You should know that. But you don't have to know what is the exact amount of TCS, TDS, on which TCS is applicable, on which, like, broad things you should know. Okay, you can forget the figure, but you can read the remaining sentences. Okay, then you should know on which customs duty will applicable and which is not. Okay, then you can say in this budget it is announced that on some cancer drugs and on some medicines and foods of rare diseases. Okay, on some cancer drugs and on some medicines and foods of rare diseases, government has exempted the customs duty. Okay, then there is something called security transaction tax. We have seen. Okay, it is a direct tax receipt. In the direct tax, we have seen something called STTR, security transaction. It is a direct tax. What is security transaction tax? So in financial system chapter in economy, you will read across something called securities. So when you transact the securities, what are securities? These bonds, stocks, etc. Sorry, not bonds. These stocks. Okay, all of these are called securities, derivatives, etc. Securities. So when you transact the securities, that means whether you buy or sell, you will be paying something called security transaction tax. Okay, this is usually seen in stock market. So they have increased this security transaction tax from 0.1 to 0.15 on some transactions. Okay, so there is a marginal increase. So this year, see, what is budget in a way? What is budget in a way? This is actually continuation to our discussion. What we are saying, India needs to fiscally consolidate, India needs to show fiscal discipline, it needs to increase its revenues, decrease unnecessary expenditure, increase capital expenditure, and budget is the way to do this. So we have seen in economic survey what government has done till last year and what is budget, what is government going to do for the next year. So this is fiscal policy for the next year, fiscal consolidation for the next year. Okay. So you are seeing exemption on duties on some, imposition or increasing on tax on some things. Okay. Then government for promoting investment has given tax holidays. That means it has exempted from payment of taxes to companies which are establishing data centers. Okay. So we have this development of cloud technology, artificial intelligence. So all of this needs storage space, which are data centers. So any foreign company which is establishing this cloud storage facility or data facility in India will receive a tax holiday up to 2047. See, such a large period. So you establish a data center in India, we are in 2026 till 2047. For the next 21 years, you don't have to pay any tax to the government. Okay, so such a huge concession to the foreign investors. Then we have established something called Gift City in Gujarat. So for prelims, you should know what is Gift City. Okay, go and read this factual basics of Gift City. Okay, and in the Gift City, we have something called IFSC. Okay, International Financial Stability Center, etc. Okay, IFSC. So this is in Gujarat. Okay, I think in Gandhinagar. So for the banking units, for the offshore banking units in this IFSC, so we have given a tax holiday for another 10 years. Previously it was 10, now another 10 added, so 20 years. Okay. Then customs duty has been exempted on capital goods that are needed to process critical minerals. So in previous class we have seen there are something called critical minerals, okay, which are highly available in China. Most of the countries in the world are dependent on China for the critical minerals and another thing called rare earth minerals. So India needs these critical minerals. These are very critical for India. So to reduce the import dependence on China, we need to produce the critical minerals in India itself. So any machinery, any capital goods that are helpful in producing these critical minerals in India will be exempted when they are imported. Okay, no customs duty. Okay, that's how it. Then there is something called safe harbor policy for IT companies. That means you report some basic income, we will not scrutiny you very harshly. Okay, it's a factual one. Go for the safe harbor. Some IT companies take some safe harbor if they report their income properly. Okay, in some transactions, it is called safe harbor policy. So the threshold was increased for safe harbor policy. Then exclusive economic zone. So we know this UN clause. Okay, UN CF law, UN clause. There is something called UN clause. So this is the territorial waters, all the land of the country. Then this is territorial waters. So everything happens in the territorial waters is under the complete jurisdiction of India. So from 0 to 12 nautical miles, from 12 to 24 it is under geography and environment, but I'm telling you here, from 12 to 24 it is called contiguous zone. Okay, just Google UN clause. Okay, UN CLOS, you will see the clear picture of it. Okay, it will be very nice. Okay, after contiguous zone you will have something called exclusive economic zone. Okay, exclusive economic zone, an area where India has exclusive economic rights. Okay, any natural resources found in this region are India's. Okay, so almost up to 220 kilometers from this land shore, this beach is the exclusive economic zone. So in this exclusive economic zone, anyone who is in this exclusive economic zone, anyone who is catching fish, okay, or even the high sea, even beyond this exclusive economic zone. High sea means beyond this exclusive economic zone. So anyone who is catching fish in this region and they are bringing back to the country, it is duty free. Okay, they will not be paying any amount. Okay, they may pay amount in this contiguous zone or territorial waters, but they will not pay in this exclusive economic zone and high seas. Okay, so that is the concept here. So again, these macroeconomic fundamentals given in the budget. We have seen the macroeconomic fundamentals discussed in the economic survey. What about the macroeconomic fundamentals discussed in the budget? Okay, so budget says for the upcoming financial year, my target of fiscal deficit is 4.3% of GDP. So already I came till 4.4%. Now next year it is 4.3%. So I am continuing with my glide path. Okay, so I told you the glide path at the beginning. We have started from 9.2 from very high. We are reducing gradually. So we are going with the glide path. Okay, so see here, graphs are given for various kinds of deficit. So fiscal deficit continuously falling, starting from the pandemic. Forget before the pandemic. During the pandemic it increased drastically, but you will see a consistent continuous decline since the pandemic. Then comes the revenue deficit. So what is revenue deficit? So we have divided the budget between capital budget and the revenue budget. I am particularly talking about the revenue budget. Okay, in the revenue budget, the difference between revenue expenditure and the revenue receipts is the revenue budget. Okay, it is also consistently falling for the past 5 financial years. Okay, so consistently falling. Then comes the primary deficit. What is the difference between fiscal deficit and primary deficit? There are various kinds of deficit you will read in static economy. So what is fiscal deficit and primary deficit? See, I have taken some loans already in the previous years. There may be a loan taken by Indira Gandhi in 1970s, but for that present Narendra Modi government has to pay some loans. Whatever the loans government is taking right now, future government under future prime minister will pay. So this is how it happens in reality. So whatever I need to borrow this year, that is okay, but some amount of that borrowing I am borrowing because I already need to pay to some past interest on some past borrowings. So all the amounts, all the loans I have taken in the 2000, 2010 for 30, 40 years. So I need to pay interest for them. I am not using it for revenue expenditure or capital expenditure. So when you minus interest payments from fiscal deficit minus interest payments, It is called primary deficit. Okay, sorry. Interest payment. It is the primary deficit. It is the actual deficit. It is the more good indication of something what present government is doing. Okay, because past interest payment it's not in its hand. They were already taken. We need to pay them to maintain our credibility. Okay, then comes this fiscal primary deficit is also continuously falling for the past 5 financial years. Then comes the effective revenue deficit. What is effective revenue deficit? So this revenue deficit I told you, in this revenue deficit, in this revenue budget we have seen under revenue expenditure there are some grants given to the state which states are using as capital expenditure. Okay, so for capital creation. So if you take out the grants from this revenue deficit, you will arrive at the effective revenue deficit, because some part of the revenue deficit of the union government is actually used for capital creation as capital expenditure by the states. So from the country perspective it is not bad. You can take out that, then you will arrive at the effective revenue expenditure, which is the actual amount. Okay, more accurate show of revenue deficit. Okay. So this debt to GDP ratio, currently we have 56.1%. Okay, total debt of the government to total GDP of the government. Then for the next financial year we want to reduce it to 55, and by 2030 we want to take it to 50%. Okay, we already seen this. So here comes two concepts. One is gross borrowings. One is net market borrowings. Okay, gross borrowings, net market borrowings. What is gross market borrowings or gross borrowings? What is net borrowings? So let's say for example, India government is taking 77,000 crore this year for borrowing. Just as an example I am saying. This will be my gross borrowing. All the amount I am borrowing this year for 7,000 crore. But I am not borrowing all this 7,000 crore to use for this year. There may be a past loan. Let's say in the year 2006, Government of India has taken a 1,000 crore loan for 20 years. In 2006, Government of India has taken 1,000 crore loan for 20 years. For 20 years, Government of India paid interest every year. Now the maturity period ended. So in 2026, Government of India has to pay back this principal 1,000 crore. Okay, so to pay this 1,000 crore, this year I need 6,000 crore, which is my actual borrowing. I need only 6,000 crore. But I also have another past loan which I need to pay this year. So I need to borrow another 1,000 crore freshly. Freshly I will borrow another 1,000 crore to fund my past, closure of my past borrowing. So here you will say this 6,000 crore is the net market borrowing which I actually need. That remaining amount is need only to close my previous debts, but the overall amount I have borrowed is the gross market borrowing. So in the previous slide when I said our capital expenditure is more than our net borrowings, means I meant this amount. Okay, not gross amount. That is the golden rule I am talking about. Okay. So to finance the fiscal deficit, net market borrowings are 11.7 lakh crore. Okay, and gross are 17.2. Okay, so the difference, which is 5.5, is roughly taken, borrowed, that amount of 5.5 lakh borrowed to clear the past loans. Okay, this year. So my gross borrowings are 17.2 lakh crore. My net borrowings are 11.7. Again, these figures you don't need to remember, but that explanation I gave you, what is gross market borrowing, what net market borrowing, that you should know for the exam. Okay. Debt levels, please remember, because they are continuously in news. In fact, this is the main focus of the chapter. So you should know those figures because India also has a target. You have to know what is the present amount so that you can remember the target. Okay. So capital expenditure is very good. So our gross borrowing is 17.2, our net borrowing is 11.7, and our capital expenditure is more than net borrowing, which is 12.2 lakh crore. Okay. For the upcoming financial year, we're talking about. Okay. The budget for the upcoming financial year. So if I include the grants given to the state also, my total capital, this is normal capital allocation, normal capital expenditure. When I include grants given to the state, this becomes effective capital expenditure, which is coming around 17.1 lakh crore. Okay. The GDP growth, as I told you, real GDP without inflation. Real means inflation not included is 7%. When I include inflation, the prices increase also. Nominal GDP is 10.5 crore. Sorry, 10.5% growth rate in GDP. So budget we have done, economic survey, this chapter we have done. Now let us discuss the recommendations given by Finance Commission related to the fiscal policy. Okay, fiscal developments. So this theory part you already know, we have already seen what is Finance Commission under Article 280. This all we have seen. Who is the chairman? The period of the economic survey, period of the 16th Finance Commission is for this period from April 2026, upcoming April, till March 2031. These 5 financial years, for these 5 financial years, 16th Finance Commission has given its recommendations. Okay. Government may accept some, may not accept some. It is a completely recommendatory, not binding on the government. Now let us see the recommendations of the 16th Finance Commission. So first you should know, so we have various types of tax systems. So all the types of tax revenues government is collecting. Some of the tax revenues will be shared with the states. So in constitution you will have many articles. So in the constitution it is clearly specified that which type of taxes union government will get, which types of taxes state governments will get. Because union government is larger, it having so much advantage, it will get so much of money. So some amount of that money it needs to give back to the states. How much of the money union government has to give back to the states? So out of 100%, for every 100 rupees union government is earning as tax revenue, not as surcharges or cesses. Only taxes are about taxes I am talking about. Okay. How much I have to give to the states, union government will ask to the Finance Commission. Finance Commission will study, they will take opinions on various states and they will come back to the union government. They will tell, sir, this is the amount you have to give to the states. So for every 100 rupees union government getting as tax, 15th Finance Commission, the previous one, okay, chairman of 15th Finance Commission is N.K. Singh, okay, N.K. Singh, 16th Arvind Paranganere, okay. So 15th Finance Commission said, sir, out of every 100 rupees you are earning, please give 41% to the states, all states combined. Okay, 42 if you include Jammu and Kashmir, but Jammu and Kashmir was divided into 2, okay, your 2 union territories. So to states it is 41%, excluding Jammu and Kashmir and Ladakh as union territory. For remaining you will give 41%. So 16th Finance Commission continued the same. Whatever 15th Commission recommended 41%, 16th said, sir, let us continue this is good. Now all the 28 states in India together gets this 41%. Now you have to divide this 41% among these states, 28 states. Okay, so this is called vertical devolution. This is called horizontal devolution. Okay, between union and state it is vertical. Among the states it is horizontal. So out of this 41 rupees, you will give 2 rupees to Maharashtra, 1 rupee to UP, like that. Okay, horizontal distribution. Now how do you decide how much will go to the state? Which state should receive higher amount, which state should receive lower amount, etc. How will you divide among the states? This is the criteria. Okay, distribution of central taxes among the states, they will come up with the criteria. See the criteria of 15th Finance Commission here. this comparison is important. This is important for both prelims and mains. And see the criteria for 16th Finance Commission also. Okay. If you see the criteria of 15th Finance Commission, it is talking about something called income distance. Okay, income distance. Income distance means the per capita GDP of top states and per capita GDP of bottom states and the difference between them. So there are some states with high per capita GDP like Maharashtra, Tamil Nadu. There are some states with very low per capita GDP like Bihar. So the distance between top states and the bottom states is the income distance. So that they will gather the weight. Okay, based on this weightage they will distribute. So income distance is given 45% weightage by 15th Finance Commission. You can see 16th Finance Commission has reduced slightly this income weightage 42.5. Okay. Then, so they will score every state on this. So those states which are having higher score will receive higher amount out of this 41 rupees. Those states which are receiving low score overall will receive low amount. Okay, the score of states, the amount of share will be decided by the total score out of this 100. Okay, then comes the population. States having higher population will receive higher amount. States having lower population will receive lower amount. The weightage for the population is 15%. Here you can see the weightage for the population has increased. That means most populated states like UP, Bihar, they will receive more as per this formula. Okay. Then demographic performance. That means performance on reduction of population. So in 1960s, 70s, etc., we are so much worried about our population. So we have given so much calls for controlling the population to various states. Some states have followed it, some states have not followed it. So which states have followed, which states have not followed. So see, demographic performance, those states which have controlled their population better will be given 12.5% weightage by the 15th Commission. Now it reduced to 10%. Now it got reduced to 10%. There is also another change in this. So the period which we will consider for this demographic performance is fixed by between 1971 to 2011. Okay, the performance between this period only will be considered by 16th Finance Commission. You may do very good before 1971, they will not consider. Whatever you are doing after 2011, they will not consider. This period only considered. Okay, and then when we are saying population, which census they will take? 2011 population census. See, 2021 census supposed to happen, but because of COVID it did not happen. It did not happen till now. Okay, so which census will be taken? If in a prelims question comes, what is the reference for population of, which census is reference for the population for 16th Finance Commission? It is also 2011. Okay, then comes the geographical area. Geographical area, 15th Finance Commission given 15% weightage, but 16th Commission has reduced it to 10%. That means larger states, smaller states. Okay, smaller states will receive lesser, larger state will receive more because geographical area also has given weightage. Forest area. Okay, this is total geographical area. Okay, this is only forest area. Okay, states like Madhya Pradesh. See, Rajasthan is larger than Madhya Pradesh, but Madhya Pradesh has more forest area than Rajasthan. Okay, so forest area in the state same, 15th Finance Commission 10 and 16th also 10. Then 15th Finance Commission has set up a parameter called tax and fiscal efforts. How much effort states are putting in increasing the tax? How much effort states are putting in controlling their fiscal deficits, etc. So the tax and fiscal efforts were given some incentive by 15th Finance Commission, but this component was removed by 16th Finance Commission. Instead, it has created a new component called contribution to the GDP. So how much every state is contributing to the GDP of the whole country matters. It is increased to 10%. So it has reduced various indicators. It has increased this contribution to the GDP and population. Okay, contribution to the GDP and population. So this is the distribution mechanism of 16th Finance Commission. For prelims, you should remember it. Okay. So one more important thing, facts you will read. I will just skim through. So facts you will read. One pattern continuing from the 15th to 16th is we are moving away from entitlement based distribution to performance linked based. Okay. So what is this entitlement based? It means it is my right. State government, let's say central government and state government belong to different parties. State government may not be listening to central government. You can see Tamil Nadu government has disagreement with union government on many things like PM3 scheme, etc. So central government will put some conditions. Behave fiscally, show some fiscal discipline, don't give unconditional cash transfers, etc. Center will give some conditions. State may listen or may not listen. So if it is entitlement based, it is my right to get that share of the tax. But when if it is performance linked and conditional linked, it is linked to the conditions and performance targets set by the union. So this is a debate about federalism. Okay, federal issues. GS paper 2 of India. Okay, federal issues. So you can see we are moving slowly away from the entitlement base. We are moving to the conditional and performance link. What does this mean? This means 16th Finance Commission came up with many conditions. Okay, you want money from us. Okay, not only this share of taxes, union government will also give some grants, we have seen. So there will be some grants flowing from center to the states and even local governments. How to give that grants? 16th Finance Commission will give some recommendations. So how that grants will go, what are the targets they need to meet, etc. 16th Finance Commission has given some recommendations. 16th Finance Commission told, dear Union Government of India, central government, please limit your fiscal deficit to 3.5. Right now we have 4.4. So it is suggesting to reduce 3.5 by 2030. Then it is also telling the states, every state shall control their fiscal deficit to 3%. 3%, okay, of the state GDP, GSDP. Okay, total debt, okay. The total debt currently we have around 81% general government debt, okay, of all union and state governments combined. So it is suggesting for state and centers to reduce from 81 to 77.3 by 2027 and 73.1% by 2031, okay. And it is suggesting the state governments to end this off budget borrowings, okay, so it is suggesting to the states to end this off budget borrowings, okay, and all liabilities must be transparently declared. Whatever the loans you are taking, please declare it transparently. Don't hide it. Don't use these other agencies as a cover to you. Okay, be transparent. So there are various conditions for various kinds of transfers, rural local bodies, urban local bodies, okay, disaster funds, etc. There are various conditions for all of this, okay. More funds for urban areas, etc. Okay. Local body grants. So you can see the conditions here, okay. Factual, please read it. Okay. So that is about the 16th Finance Commission recommendations related to fiscal policy. So we have seen all three documents, 16th Finance Commission, budget and economic survey related to the fiscal developments. So let us see some previous year questions on this topic to understand how questions are coming. Okay. So you can see last year there were tricky questions. These are past questions. I think last year question is missing. So I will add last year questions in the next class. But see this question still 2024. So which of the following best describes the term fiscal deficit? So among the given options, which of the term best describes fiscal deficit? Okay, you can just pause the video and try yourself. Okay, then they are asking about something called FRBM Act. So in 2003, because our fiscal deficit is constantly high, we have made an act called FRBM Act. Okay, Fiscal Responsibility and Budget Management Act, etc. The target here is to reduce the fiscal deficit. Okay, fiscal deficit to 3%. Just like whatever our 16th Finance Commission is telling us right now. FRBM Act, we have set a target for ourselves to reduce the fiscal deficit to 3%. But we could never achieve it actually. There were many troubles, etc. In 2008, we have seen there is a financial crisis. In 2020, COVID-19 pandemic. So even till today, we are in 2026, still our fiscal deficit is 4.4%. So this FRBM Act, in a way, it has become useless. Okay, even the previous 15th Finance Commission also said, sir, this has become useless. So stop focusing on fiscal deficit. Stop excessively focusing on fiscal deficit. Focus on debt to GDP ratio, which is high. Okay, which is very high. So that is why we are now focusing on this debt to GDP ratio, and union government has 50% target. Okay, from present 56%. So instead of focusing on reducing fiscal deficit, we will reduce fiscal deficit. We have something called glide path, but we will focus on debt to GDP ratio as our target. Okay. So before pandemic in 2018, there was a question on FRBM Act. So there is a question on which of the following are included in revenue expenditures, etc. Okay, all three will come. Then there is a previous year question on if government borrowing increases significantly, what is likely the macroeconomic consequences? So if government is borrowing too much, what will happen? There will be less money in the country. Okay, there will be less availability of the loans to the private parties. When there is lesser amount, private parties, they will not have money to invest. So it will result in crowding out of private investment. Crowding out, they will not, crowding means all are gathering together. Many people establishing, many people investing is crowding in. When they are moving away from investment, it is crowding out. So excess borrowing is already bad. We already know that. Excess borrowing is bad. So there is a question on GST. Okay, what is GST, etc. So this year you can expect more questions on GST. Okay. So that is about the chapter 2. So last year 2 or 3 questions are also came from this topic. Okay, in next session I will add because they are somewhat tricky. Okay, so let us end our session here. Thank you.